So I know you've got quite a big interest in property, but maybe help guide us here. Been property shopping, I found a property that I love. And do I maximize in terms of this is my disposable income, so I throw everything into buying the property? Or should I be scaling back and look at a lower value property so to give me a bit of a buffer or access to other potential investments?
Well, so I think property, like any other big purchases that you make, you have to realize that the maximum that you can qualify for is not necessarily the target. It's actually what you, between you and the bank, look at your finances and say, this is actually the maximum that you can potentially be able to manage and afford. But in reality, property or paying for rent and paying for a mortgage is just one of the essentials that most people face. You still have a whole long list of other essentials that you need to look at. And for me, management of your finances and your disposable income to make sure that you've got enough breathing room to fit all the essentials is absolutely important. And thereafter, after you know then how much you can rightfully take in terms of pay in terms of the property, that's when you work backwards in terms of what does it look like in terms of the property you're looking for and where, and also what are the consequential costs, I think we're going to talk about later, of buying that specific property.
Maybe let's just jump into it. As in, you find your dream property, but the cost that you're seeing is not necessarily the only cost you're going to incur, unfortunately.
Well, I guess with property, it's a feel-good investment or an asset. So it's very, very easily to fall trap of just buying and then holding that property. First, there is the different ways of or different types and different needs of buying the property. It could be for primary residence where you're going to stay with your family. It could be a holiday home where you're going to use it now and then during the year. Or it could be for investment purposes where you're building a portfolio. But no matter which category you fall under, for me, there are costs that are associated with those properties. And for me, I always, back of my head, categorize them into three groups. Those direct costs, like your transfer duties, bond registration costs, your rates and levies to the municipality and the body corporate if you're in any state, maintenance of the property, insurance for the property. Those are pretty quite can be expensive put together. So you don't just look at the bond repayment; you look at also those expenses.
I like how you called it. It's a feel good finding the right home and buying it. But I guess, given your answer, it also doesn't feel so good when the interest rates are going up.
Yeah.
Which is the other side of it as well.
That's the other side of it when compared to renting, especially for primary residents, you always have to weigh, do I take and stomach the bond repayment with all these costs versus just paying a rental fee and it's no longer my problem. I've got a home and I've got flexibility to move whenever I need. And if you've got children, as children grow, you optimize about where you stay closer to work or closer to the schools. So there's that flexibility with renting. So you need to be cognizant of that.
Your view, and I won't hold you to it. Do you see property as an investment? I know there's lots of different views, and especially when you look at financial planning, where do you put property?
I see it differently. I see it as an asset. And like any other asset, it either you maintain it very well, and then you know where it fits in your balance sheet, your personal balance sheet. And with every asset, there is the liability side. Either you used your money or use someone else's money. And for me, the right balance is to make sure that if you're using a bank's money, you're maximizing in the value you're getting out of that property. If you're using your own money, you must realize you've got very, very low diversification on that asset. So for me, I always like to see it as an asset. Maybe it's more of my training as an actuary and having the numbers and the liabilities and assets, but it does give me a good framework in terms of then how do I place it within my finances.
And I guess not forgetting that it's seen as a high risk type investment, whichever way you're looking at property.
Yes, it's definitely high risk in that it's very illiquid. So you can't just get in and out of a property that easily. It's very impacted by the market conditions, but also it's a very, very big purchase. So if you want to sell, you need to find the right buyer who's going to buy it at the right price. And also it's very, as I said, there's no diversification. So if that property in the area where you are in is now doing badly for various reasons, you're stuck in that for a very, very large amount that you're exposed to, compared to the markets where you can be exposed to very, very different stocks and very different companies, and even bonds and equities and cash, offshore and onshore. So it's quite a lot of diversity you can get in the market compared to a property.
And then talk about risk. I mean, the other side of it obviously is for many of us, we're having to take out a loan in order to afford a property. And that loan could be sitting with for the next 20, 30 years. What's the risk there, and how can one start protect themselves given that this long-term loan?
Well, I've seen a lot of clients, especially who are managing their finances quite well, paying off their loans, say in 5 or 6 years. But in reality, 5 years, 6 years is a long time, let alone 20 years. And in just in a space of 5 years, a lot can happen. Just think about 5 years ago and where you are now, a lot can happen. What I typically find in South Africa is that a lot of people look at life cover as a death benefit to protect themselves and their family against the home loan. So it gets cycled if you die. But the reality is that the biggest exposure you face is that you don't die. So you have a cancer, you survive it. Have a heart attack, mental health, diabetes. It's a long list of conditions that are actually more likely to happen in the space of 5 years. Again, in 20 years, it even becomes a bit more higher risk that you'll be exposed to those conditions than dying.
Right. And I guess when you're vulnerable, the last thing you want to have to do is have to sell your property to afford whatever care you actually need. So
Yes.
that becomes quite important. I mean, a lot of people are employed. The people that are employed, they'll always say, I've got group benefits. It gives me my life cover. I'm covered for whether it's illnesses or from a life perspective. Do I need to be looking at anything else in addition? Especially in the context of owning a property and covering yourself in that regard.
Yeah, I find a lot of people have got a false sense of security with either the cover provided by their employer or their provident fund or pension fund. And then they think they're fully covered for everything, but that's not the reality most of the time. Typically, your cover through your employer will cover you in the event of death. However, there are a lot of restrictions and a lot of conditions to that cover. The trustees of the retirement fund or your employer will have to look at the dependents, who may not necessarily be the people that we live with. Could be anyone else who's financially dependent on you. So there's Section 37C that is required and can take up to a year to finalize that process. And in that interim, your family and the bank need to make sure that the home loan is repaid and honor those repayments that are due. And also, I do find that a lot of people then, even when they realize that shortcoming, they then go out to the open market and buy insurance, life cover, to secure the property, which is a good thing. Because in the event of death, then the life cover will pay out quite quick, but sometimes it's not efficient because life cover remains level while your home loan may be reducing over time. So the most appropriate solution for most families is usually have a mortgage protection cover that is linked to that bond, and it doesn't go through the process of having to pay to beneficiaries and hoping beneficiaries will cycle the home loan, but it goes directly to the bank to cycle the bond, and then the property then belongs to the family. And then the other reality is that it's not always about death. South Africans have to learn that it's not always about death. The biggest risk they face, even with the property, is the living conditions, the conditions that they will live with, like diabetes, cancers, and strokes. That if they suffer those, who's going to shoulder those repayments?
But even I mean, you mentioned mortgage protection cover. Isn't it also a long, drawn-out process if when you need it, it's not quite there, available, and ready to pay?
Well, actually, it's exactly the opposite. Unlike life cover, because it's linked to a specific asset, the process to get a mortgage protection cover is one of the simplest you'll find in the insurance market. And typically answering a few questions and within a few minutes, and typically it's online rather than having to do a lot of paperwork. And sometimes, more often, especially if you're younger, without any blood tests. And that very, very quick to the point, and you get that property protected and covered.
Thank you very much, Jason. Maybe as a last question, do you have any secrets you want to share in terms of getting into the property market and making it a success?
Cheers. Not to fall into the trap of offering financial advice, but the reality is it is a feel-good investment. I think if you really love properties as an asset or as an investment to hold, do your homework, do your investigation, find the right type of property in the right area, and then that all depends on whether you're going to be living there or you're going to be doing it for investment purposes. And if you're doing it for investment purposes, think about who your client, who's going to be a tenant, going to look like and looking for. So that's what you look then for in that property, and then always look for something that's going to be affordable to you. Even if it's for investment purposes and you'll get rental income, vacancies are a reality in South Africa when the market turns.
Thank you, Jason. We'll catch up for another coffee another time.
Thanks, Tabiso.